Hi, AP students. We're starting our new unit today. Actually, our last unit. It's going to be broken up into a couple different parts. But either way, here's your notes. You'll get linked to. This is what they'll look like. You're going to fill in some blanks as we go. Um, keep up as we go. I'm going to try to keep things quick. Respect your time, and that is a little bit of a difficult thing to describe without physical examples. But we'll do our best. By all means, if needed, email me when if you have questions. Okay, so we're starting out with some key terms here. I think they're generally a review of some terms, but remember, imports and talking from a viewpoint of like the United States, and what we're getting into is, what happens when we import and export stuff. Remember, we're going to have to sometimes, transfer cash in terms of in terms of our transactions. Okay, so we're going to look at things as we kind of go through this from the standpoint of the United States. It doesn't always have to be. Obviously, an exam type question might be country A versus country B, but either way, that's kind of where we're started. Okay, and what we're trying to get to in this particular video is describing what happens when we're trying to import or export goods to different countries. Okay, so anyway, imports from the viewpoint of the United States, that's what we get from the physical good we get from another country. Okay, so notice it's goods and services. Exports the opposite. Okay, we're going to obviously send goods and services to other countries. And when we do that, okay, realize that when we import something, we get the physical good from the other country. Well, they give us, I'm sorry, we give them money. Okay, so we give them the United States dollars. Well, now they're stuck with those United States dollars and they've got to do something with them. And we're going to assume they can't use them domestically. Okay, so they can't spend them in their own country. So they have two options. Option number one, pretty straightforward. They can use those American dollars to buy American stuff, right? And that kind of leads to those exports. Option number two is they can invest in things in the United States. And so whether that means buying the United States stocks or loaning money to the government even, there's different investment options. They could even save it in an American bank if they wanted to. Okay, so keep in mind they've got to do something with that money. We're going to physically show that here in a second, the best that I can on this computer screen. Okay, as we get there. A trade surplus, that means we import more than we that means we export, sorry, more than we import. So again, that means that we're getting more money brought in, right? And a trade deficit means that we are importing more than we export in terms of a dollar amount. Okay, we'll talk about how these kind of flip. These are kind of listed here in a little bit of a different way, side to side. We'll talk about how we can draw that easier here in a second. Notice we're going to call exports and imports. We're going to abbreviate them with X and M, which actually is a little bit of a review. We did that when we started measuring GDP as well, but we're going to label exports with an X, imports with an M, outflows with an O, and inflows with an I when we get to that particular point. Okay, so we're going to use those abbreviations. It's not perfect, but we have seen them before if you remember. Okay, so couple different terms you're going to hear. The current account is going to track the exports and total imports. Okay, so that's our current account. That's our goods and services. Notice what it includes. All right, our merchandise, again, physical goods and services, could be services in certain cases. Um, Also, any type of like dividend income, we can track that in there. So any physical good that's going to get sent back, right? Our financial capital account is, notice what's in there. We're talking about assets, okay? So things that can be turned into cash. So the easiest way to remember that is like stocks and bonds. That again, if I have a bunch of Chinese money and I don't want to buy Chinese stuff, right? Well, what can I do with it? Well, I can send that money into the Chinese stock market and try to earn some interest, either A, until I earn a bunch of interest and then exchange that money, which is the next unit we'll talk about, or I can obviously wait until I want to buy more Chinese goods. Again, I can create those assets. Remember also assets can come in the form of starting a business, also buying up real estate. there's a bunch of different assets you can try to invest your money in. Okay. Now, we're going to look at this from the standpoint of the United States. And so I just used Germany here. The United States exports a lot of airplanes. So just to try to visualize this, and all these things right here are in the from the aspect of the United States. All right. So in a simple transaction, the United States might send Germany an airplane. Germany is going to send us a car, assuming they're the same price, and maybe it's two cars for one airplane, whatever. But assuming it's the same price, everything's going to be pretty straightforward. Now, obviously, if we trade evenly, the transaction of cash doesn't necessarily need to occur necessarily. It might happen, and it'll all eventually even out. It might happen, but maybe it doesn't. Now, let's say that we get two cars, and again, assuming that airplanes and cars are the same value, right? I've got to send some money over here to Germany. All right. So I send the United States dollar over here to Germany. Well, Germany can't spend this dollar in Germany, right? So they're going to have to send this dollar back over here into the financial sector of the United States. That's going to be an inflow of investment for the United States. Okay, and again, all these potential financial assets, stocks, bonds, real estate, whatever that is, okay, they're going to send this money back over here. They're going to own these physical goods, right? And so then Germany has a couple different options. Well, like we kind of said before, they can wait for that money to um, you know, accrue interest and eventually be worth more. Maybe eventually they decide to buy an airplane, right? And now we send that money back into the United States. They can do a few different things. But as these things are always happening, right? This flow of money is constantly happening. And again, it's not a government decision that's doing this. This is more of like an individual basis. And so it happens constantly and on real small levels. We're breaking it down to just one example. So let's just say for one more example here that we're going to export airplanes to Germany. We don't want to buy any of their cars. So now we have these euros. Okay, we're stuck with these. Well, we've got to send these euros back to Germany. We can't use them here. Okay, we can't necessarily go to the grocery store and use these euros to buy things. So this becomes an outflow. All right. And this outflow is going to eventually be invested into the German economy one way or the other, in their stock market, on real estate, whatever that might be. Okay, so that outflow becomes that export that we sell things good, right? But again, when we get that German money, we've got to go reinvest it back over there. And that can be a good thing for Germany, right? Because if we, for example, like if we have a company in the United States that is financed by Germany, well, that might create jobs over here. If I'm going to, try to, buy stock in Germany, if that stock's in demand, well, somebody's selling that stock and they might be making a profit on it. So it works both ways, okay, in terms of how and who it's going to benefit. All right, we'll kind of touch base on that one more time a little bit later on. Okay, so how can we keep track of this stuff? Because there's kind of a lot going on, and you should see a chart on your notes that is describing what I have drawn here. Okay, so first of all, if everything is equal, and every time I get one of these, you're going to be asked a question, and we'll give you a sample question here in a second, is, what happens if the United States has, an equal current account with Germany? Well, things get pretty easy. Okay, so if it's an equal current account, so exports equal imports, all right, we know that, and I have China in this example, we know that exports and imports also are equal in China. Now, if these are equal, we also know that our financial account is going to be equal as well. Okay, so our outflows versus inflows, we know that those have to be equal as well. Same with over on China's side. So if things are equal, it's pretty straightforward. All right, now how do I use this chart to my advantage? Well, I have this X and O boxed in here. And those of you familiar, well, it was really popular like in World War II, but even my mom when she writes me like a birthday card or whatever, she signs the card XOXO, which used to stand for, or maybe I guess still does, for hugs and kisses. And those hugs and kisses, that X and O, right? I try to pair them together so I know, and you'll see here in a second, that I can draw my inequality sign one way or the other. Okay, so you'll see what I mean by that once we get to this practice problem. All right, so here's our question here. All right, when we can determine whether a country has imported or exported more than another country, all right, we can determine the status of the current and financial accounts. So I give us here, all right, assume that USA has imported more than exported from China. So my M is bigger than my X. And this is a potential question that you would get on a test, right? They're going to say, well, what does that mean for the financial account in China, right? Okay, so first of all, we have a current account, in this case, surplus. I'm sorry, we have a deficit. I apologize. We import more. We're sending more money to China. Now, what we do know is that China, in this case, is exporting more than they are importing. Okay, kind of a real life example between the United States and China. Okay, and we know that that's a surplus. All righty. Now, what we also know, and remember, we're going to keep our X's and O's together, so we can already draw these in. O, I, right? So we know that since we are sending way more money to China, they are sending way more investments to the United States. Okay, so we have a surplus in our financial account. They have a deficit their financial account. And so, if the question could be like, if the United States the states run a deficit in their current account, what does that mean for China's financial account? Is it a surplus? Is it a deficit? Whatever. That's the question that could be eventually asked. Okay. Let's try another one here. We've got assume the U.S. has more capital outflow in its financial account than China in this particular case. Take a quick second, fill out that chart. Let's see if you can figure out what you need to do. Okay, so I'm just going to kind of fill in what I need. I got an X, I got an M, I got an X, I got an M, right? All these are going to look the same. And again, you'll never be asked to draw this chart on a test situation. This isn't like a short answer thing. This chart is simply a way to keep things straight. Okay, so if we know that O over here is bigger and we set our thing up correctly because X's and O's stay together, right? Then we know over here it's going to flip. All right, so we've got a surplus in the U.S. Current account, and we've got a deficit in our financial account. We're going to flip it over here. Right? So it all works out one way or the other. Okay, and again, there's positives and negatives to it. It kind of depends on who you are when you are looking at is this a good thing or a bad thing as we go through it. All right. So just kind of word it for you here, like in a kind of a chunky notes way here. All right, is one way to look at it as if the United States is buying all these Chinese goods, right? Because they're selling us all this stuff. We like to buy cheap stuff from China. Well, we can't spend nearly as much money on Chinese assets. We can't buy that. We're spending all of our money on goods and services, right? And so we can't spend that money on Chinese assets, which, to be honest, I don't know if we would want to anyway, right? We want to be able to invest in our own economy more so than invest in a Chinese economy that hasn't always been super strong. If you want my general opinion there, all right. And then some other rules that we just talked about. Again, the big key is if I sell something to another country, they either have to exchange for my currency, okay, or they're going to pay me with their currency. And if they pay me with their currency, I can't spend it here in the US. So what do I have to do? Well, like we mentioned, I either have to buy Chinese stuff, in this case as an example, or I can invest it into the Chinese economy one way or the other, stocks, bonds, some type of asset. Okay? Like I said, these flows of income can be good or bad. right? Depending on who you are. Obviously, if I am to use kind of a recent example, the United States was importing a whole lot of washing machines from Asia in general, Southeast Asia to be a little bit more specific. And one of our government policies was to raise tariffs on those washing machines. Well, that raised the price of them, and so what started happening was we imported way less washing machines. Well, if I'm a washing machine producer here in the United States, that's going to be a good thing. I'm going to be a whole lot busier because now my price is more competitive. Okay, now on the flip side, if I am somebody that is, since that account was changing, somebody in Southeast Asia, we'll just use China. We'll just use China as an example. Well, now one of their people that were making money off that, right? That were collecting these U.S. dollars, so to speak. Well, now they're not going to invest in the United States stock market. And if I'm trying to sell my stock to this potential buyer, then I'm not going to make as big of a profit because that demand for my stock is going to decrease. Now, is that going to affect as many people as what the job labor market's going to create or affect? No, probably not. But it can be beneficial or detrimental depending on what your standpoint is. There's always going to be these trade-offs. All right, so just a couple quick questions here we've got for you. Pause the video and kind of run through it. You may have to draw up those charts, but take a second and again, these are sample questions that you might eventually see, and they are worded like this in a free response question sometimes. Um, but either way, go ahead and go through. Like I said, you can draw out those charts. Really, you only need to draw two charts, right? Because then you can just kind of compare and find what you're trying to do. There's only two options, right? There's only two combinations. Okay, pause it, take a quick second, go ahead and go through it. All right, number one, I have a deficit. I've got a negative net capital inflow. I've got a positive inflow, and we use the term surplus or short or deficit on those. Negative means deficit, positive means surplus. Okay, we've got negative inflow, surplus, deficit. All right, so that's where we're at. Hopefully, you're doing those well, and giving yourself a chance to be successful. Just to kind of prove our point, historically in the United States, this gives us the foreign investment. You can see it mirrors each other almost perfectly it does mirror each other perfectly as you look at that from the Bureau of Labor statistics. All right, that's what I've got for you today. Hopefully, that makes sense. Don't be afraid to look up some additional resources. All right, different people explain things a little bit different. There are plenty on YouTube. Just simply research AP macro balance of payments, and that's what we talked about today. We'll be back soon with part two of this unit. Keep grinding it out.